Hi everyone, and welcome back. For those of you who are new to this channel, my name is Marion, and I am a certified public accountant at Marion & Associates LLC. We have decided to start to put together a series of videos containing hot topic issues after seeing all the mistakes that have been made by individuals preparing their own tax returns. We hope these videos will provide those individuals with the knowledge needed to prepare their own tax return, or to know when to seek out the advice of a tax professional. Please make sure to subscribe so you do not miss any of the new videos that get released. Please comment below if there's a certain topic that you would like to learn more about. If we notice enough people requesting the topic, we will make sure to develop a video on that specific issue. A lot of the individuals we talk to believe that they do not make any errors on their tax return. Let's take a look at the most common errors our firm has seen on self-prepared tax returns.
In today's episode, we are going to be talking about the top 5 mistakes found on self-prepared tax returns. Over the years at looking at self-prepared tax returns, we have come up with the following top 5 lists. There are many other mistakes that our firm has seen on self-prepared tax returns. However, today we are going to be looking at these 5 in more detail. Everyone loves being able to claim a tax credit on their tax return. Tax credits reduce the amount of tax you owe dollar for dollar. However, you need to be sure that you are claiming eligible tax credits. Claiming a credit that you are not eligible for could cause an audit, and by not claiming a tax credit that you are eligible for is leaving money on the table. The IRS is determined to increase the compliance of all taxpayers. Make sure to claim only the credits that you are entitled to claim. Individuals that make contributions to traditional IRAs may be able to claim a deduction on their tax return. The deductibility of an IRA contribution is based on income limits and if you are covered by a retirement plan from your employer. If an individual makes an IRA contribution that is not deductible, then there is basis in that IRA. Basis in IRAs are very important and need to be tracked. When an individual takes a distribution from an IRA that has basis, the full amount of the distribution is not taxable. This rule also applies to inherited IRAs. Most individuals preparing their own tax return completely forget about the basis in the IRA and pay more in taxes than they should. Some companies have the ability to offer their employees some type of equity compensation plan. Most individuals know these as stock options. Some of these plans are required to include the stock options in the employee's W-2. However, the individual may also receive a 1099 statement showing the same stock option transaction. So if the stock option is reported in the W-2 and the 1099 statement, are you paying taxes on the same money? The answer is yes, unless you make the appropriate adjustments on the tax return. Most individuals do not make this adjustment and pay more in taxes than they should. Individuals who are self-employed may be eligible to claim the self-employed health insurance deduction on Schedule 1 of the tax return. Individuals who are not self-employed need to report their medical expenses on Schedule A subject to 10% of adjusted gross income. Therefore, this is a great benefit to the self-employed individuals. Eligibility of this deduction is determined on a monthly basis and cannot exceed the amount of business income. Any amounts in excess of business income must be reported on Schedule A. Also, if an individual is or considered a greater than 2% shareholder in an S corporation, the cost of their health insurance will be reported in Box 1 of Form W-2 and need to be deducted as self-employed health insurance. Most individuals forget to deduct the self-employed health insurance and pay more in taxes than they should. Everyone thinks preparing the PA local tax return is so easy. However, we see a lot of mistakes made on this tax return. First, the wages claimed on the local tax return should match the wages claimed on the PA tax return. The main exception to this rule is the minister's housing allowance is not taxable on the local tax return. If you are claiming unreimbursed expenses on the PA tax return, you should list them on the local tax return. An employer is required to withhold the higher of the local rate where the employer is located or where the employee lives. The individual is only allowed to claim local taxes withheld up to the local rate where they live. The major item that individuals forget is the out-of-state credits and the Philadelphia Super Credit. These credits can be used to reduce your local tax liability and cause you to receive a refund for taxes withheld from other W-2s. We have even seen some local returns that have been prepared by other tax professionals who did not have the proper knowledge on the Philadelphia Super Credit that cost the taxpayer a lot of money that they were entitled to. It is important to ensure that you or the tax professional you hire have the proper knowledge needed to prepare the tax return. If you're starting to feel that you need a professional to prepare your tax return, be sure to check out Marion & Associates LLC. We are a family-run practice located in Exton, Pennsylvania that specializes in personal and business income tax return preparation as well as tax strategies to minimize your future tax obligations. Our firm wants to form a long-lasting relationship with you and your family, not just be another tax preparer. We hope you found this video helpful, and thanks for tuning in.